This is Cece. Welcome to the Orbit. It is Monday, November 27th. We've got futures down slightly. That follows last week where the market was higher by about 1%, slightly more than what options were pricing for the holiday shortened week. As we've been talking about on the Orbit over the last several weeks, we are in a slow rally mode with steadily declining implied volatility over the last 2 weeks. And with Friday's shortened day, we actually saw the VIX close at 12.5, which is the lowest we've seen it in a long time. Now, that might pop a little bit after the slightly longer than usual weekend, but what we've got here is extremely low vol heading into year end, which basically is pricing a very slow creep higher. So what you would be looking for as a trader for a change in volatility is any kind of reversal in the market, any kind of even a fear of a minor pullback in the market might be the type of thing that could get vol back towards that, say, 15 or 16 level. But right now it is pricing very small moves week to week and very small moves intraday. So we're looking at the SPY right now. We've got the 1 week expected move about 1%. And look at that IV. It's about 11 for at the money vol. This is extremely low volatility. And that may change because we do have some economic data coming out this week and next week. We've got kind of a GDP. Next week is non-farm payrolls. We've got CPI. We've got Powell speaking the end of this week. And so we might get some signals on the overall direction of the Fed this week and next week. And that could change things. But as of now, we're talking very small expected moves. Here we are on the 0 DTE expected moves. You can see we're about, not even a 0.5% on these expected moves. So therefore, traders need to be very aware. Let's just check. I want to look out a little bit into year end. Here's where you see, this is the CPI week. There's a little bit of a jump in IV, but not much really. We're talking here's that single digits I mentioned. You can see that 9 IV right there is very low. And then, as we get into year end, we're only at about a 2.5% expected move. And you look at this historical chart of the last, 3 months, you see that a 2.4% expected move is basically the options market saying, all of this volatility is done for the foreseeable future. And again, that can change, but it's not going to change on a dime most likely. It would have to be some sort of accelerating decline where, you have this move we've made higher over the last month. It's over 10%, 11% move higher. If you started to see a reversal where the first day was down 0.5%, then the next day was down 0.75%, and then all of a sudden it started accelerating. Well, then you're going to have investors start to look for puts maybe down, at these levels, even 445 strike in SPY. If people start reaching for those puts and then the market starts declining, that's when you're going to see the pop in volatility, and that's when you're going to see all of this long gamma that we've been talking about clear. And that's the most likely scenario for us to sort of break out from this current condition. Now, as we've mentioned over and over, when you are looking at these, especially these weekly moves, when you are in these conditions of a slow creep higher, that upside, those upside strikes, if you're selling cover calls, if you're selling credit call spreads, if you're doing iron condors, those upside strikes, you have to be very careful because, as you saw last week, that was essentially a 3.5 day trading week. And you would have been very close, if not in the money on your short strikes on an iron condor to start last week, because I believe the expected move was about 0.8%. So as you can see, that slow creep higher. So you're looking at this week's, and you're looking at a, call it a 1% expected move. You'd be as a trader, you want to be very careful on being exactly at that 1%. You might want to be a little bit outside, because what will happen is a market will tend to go outside of smaller expected moves at low IV more often. They just won't do it at a very big magnitude. So if an expected move is 1%, you might see a 1.1% actual move or a 1.2% actual move. It's very unlikely, unless you just got a news story that dropped in the middle of the week that changed everything, that you're going to see a 3% move, if that makes sense. Now, if volatility is really high, and let's say you've got a 3% expected move and the VIX is at 25, then the likelihood of it going outside that 3% move is actually less than it is right now, if that makes sense. However, in those conditions, when it moves outside that 3%, the likelihood of it being 6%, let's say, is a lot higher. So that's basically how volatility, low versus high volatility, works. Is the higher the volatility, the less likely it is to go outside the expected move, which makes sense. That's simple math. It's wider. However, when it does, the magnitude can be much bigger. When you are at low IV, when you're at a 12.5 VIX, if you go a little bit wider on your sales, then you have a much higher success rate because of that. That's just basically simple math, that it's pretty easy for the market to go 0.9% in either direction at the expected move. However, it's very difficult under those conditions for the market to make a 2.5% move, if that makes sense. So now we're looking at the SPY Iron Condor. As you can see, it's a 459, 451 short strikes. This is what I'm talking about. If you go a little bit wider, you of course are taking your max gains. So now we're looking at like 20 to 80, somewhere in this range, 20 to 25. I've just tightened it a little bit, but basically now you're $5 in either direction rather than 4. Oftentimes that is enough in these kinds of conditions, but some people might find that you need to go even a little bit wider. And of course, we've talked about those legging into and out of iron condors as well.